Okay, hi all. My clock says it's about time to start. There are a few latecomers still coming in, so can I just get a quick sound check? Let me know if you can actually hear me. Well done, Bob. You win a prize for being the first one to say yes to the sound check. Right, so hello all, welcome. This is part two of the... Sorry, just let me start my recording. Okay, hello all, welcome. This is part two of the four-part macro to micro webinar series with myself, Peter Davies, and Cam Dadwar of the Trading Framework. Now, today's topic is order flow back to basics, and this will benefit those of you new to order flow, but also for those that might have lost their way a bit with order flow, because there's a lot of distractions in order flow, as it is such a hot topic nowadays. And it's been overcomplicated somewhat with tales of algorithmic trading and HFTs, and we will touch on that today. So a lot of people have gotten quite confused about order flow. So it's a good idea to go back to basics and remember why we use it and what it's actually for. And before I go any further, we do have to go through the disclaimer. I will be talking about trading today. You all know the risks. I won't read it out loud to you, but do remember what's not part of the disclaimer is that anytime people talk about trading, they're always talking about it from their own perspective, and that means their own appetite for risk. So, you know, whenever you see something, don't just think about what you're learning, also think about what that person's willing to risk and what you're willing to risk. So you might try and adopt some techniques that somebody's telling you, but if you're not willing to risk the same amount of money, it will not end well. Okay, so those that know Jigsaw, or took a look at our website, because I know some of you are from Cam's audience, you know that we sell a set of tools for reading order flow, and those tools look at both short-term order flow as well as historical order flow. Now that is not what we'll be discussing today, or rather our focus isn't so much any particular set of tools at all. So what we are going to look at is the theme or the theory or the principles behind all order flow tools. And so our objective is to make sure there's no remaining confusion about the theory of order flow, because there's not much point in going through to webinars 3 and 4 if you don't get this stuff. Okay, this is the prerequisite. Okay, so we need you to understand clearly what order flow is, why it's relevant, and how it should be applied. Now, we have done this before. It's been a few years, and I think it's worth getting back to basics so that people don't overcomplicate things when it comes to reading order flow. Now, why exactly do we do a back to basics? Well, I've come across a lot of people that use one order flow tool but have no idea how to use others. So a good example would be somebody that trades cumulative delta divergences mechanically, but they're lost when it comes to footprint charts. So what that means is they don't fully understand the underlying theory behind the tool. So that the use of cumulative delta is somewhat superficial. It's done on the basis of using a pattern somebody told them to use, not on the basis of understanding what it's really telling you about market participation. So when those divergences don't work, I actually got an email on Monday. The email was entitled Doubts About Order Flow and our little ES When to Enter course. And the email said that basically the cumulative delta didn't work on Monday. Okay. Now, Monday was a holiday. And of course, you know, with anything can break down, a relationship can break down, but Monday was a holiday. We didn't have the same level of market participation. Can't expect the market to behave the same way. And that's the kind of thing I'm talking about. So when the divergences don't work or whatever you're looking for doesn't work, because of changes in participation, some people get a little bit lost. So they're reading the words but not understanding the story, and it's the story that's the most important. So with order flow, the 80-20 rule very much applies. That means 80% of the benefit comes from 20% of the knowledge, or 80% of the effects or the moves come from 20% of the causes. So you could build encyclopedic knowledge of order flow, but it's mastering the basics that will yield the greatest benefits. Now, we get a lot of people who come to Jigsaw and they say, well, what do I need to do? Because you've got like 8 hours or 10 hours of videos on your site. And I say, forget all that. Just follow the 20-minute New to Jigsaw Tools video, because that gets you the practical experience, and just make sure that you catch up with the theory as you go through. So it's the practical side that's going to get you the furthest ahead with order flow, not really being some kind of guru in order flow. So if you have a head full of order flow concepts and you think you need to keep 1,000 rules in your head to use them, then let's just have a spring clean. Let's just clear a lot of that stuff out, because the bottom line is that all order flow tools are simply a different view of the same information for the same reason. And after teaching literally thousands of traders these concepts and seeing the results, it's my belief that understanding the theory behind the tools will make the use of the tools more productive, but like I say, it doesn't have to be encyclopedic. So after this session, you should understand the mechanics of price change and be able to understand any order flow tool. Now that doesn't mean you'll be able to use any order flow tool immediately. So these tools are a bit like riding a bike. It does take practice, but conceptually, you should be able to at least assess any order flow tool. Now finally, this session is going to give you actionable information that you can take away and start using in your trading. Now obviously you're going to need to practice a little bit first, so dip your toe in the water, don't go all in. Now this is a very old slide, some of you may have seen this before, but we've all faced this conundrum. We have a level that we're looking at, a level we're interested in. Excuse me, just set my pointer options. Okay, we have a level that we're interested in. Market could reverse there, could fall short, could poke through and reverse, or it could just blow straight through. So what exactly do we do if we're looking at that level? We've got that level as a level of interest. We could, for instance, if we're interested in fading that level, we could put an order in before the level, and maybe have a wide enough stop, which allows it to move through and come back and still stay in. But if we do that, if we have an entry before the level and a stop right up here, that's going to mean that on your losing trades, you're going to be losing a lot of money. So you could make your stops really wide and get in before the level. You could scale into a trade so that as the trade moves your way, you add to your position side. That's good, especially if you're on a volatile market where you've got lots of room. But both those things are ways to accept a lack of precision on your entry price. But you don't need to accept that lack of precision. So you can be more precise. So using order flow, you have information to help identify if and when a move is occurring, and then trade it when you have that confirmation. Now that confirmation may come as the turn is happening, or it may come just after the turn, but it will still be a more precise entry. Now we can also use order flow to set bias. Now most markets put in good runs to the upside and the downside on most days. I mean, if you look at the S&P 500 yesterday and crude yesterday, putting in great runs, and that's a side effect mostly of speculative trading. So where people that buy short term aren't so much buyers as kind of future sellers. So on a speculator driven day, we will move in one direction, but then we'll eventually get to a point where those that bought the market, if we moved up, need to unwind their positions by selling, and that activity itself initiates a move to the downside. Then speculators jump on that new short side momentum until they need to unwind their shorts by buying, and then we start moving up. So there's this kind of speculative cycle. It's not something that happens when institutional investing is driving the market. And the order flow helps you to recognize these transitions so you can actually stay on the right side of the market. So when the order flow is biased upside, you only take long signals. When it's biased downside, you only take short signals. If there is no bias, you switch to range-bound trading. And we can also use order flow to define a pullback or a second entry, and that's a major element to the way I trade. I'm like most people, I have price points I use to identify where a major reversal might take place. Okay, now most of the time I do not enter there. Now let's say we've still got some issues with the screen. I am very sorry. Okay, I'll make sure I catch that on the recording. Okay, so we can see the screen now. Okay, sorry about that. Okay, so we can use order flow to define a second entry. Okay, like most people, I have price points I use to identify where a major reversal might take place. Now, most of the time, I don't actually enter the market there. I just think that those areas are too risky places to enter. So I'll let the market reverse or break through a level, I'll let the order flow confirm that that has actually happened. So if I look for a reversal, I want the order flow to confirm that that really was a reversal and not a pullback. And then I look for a pullback entry, a second entry. And we know that markets do stair step and we get hidden backstops created once the move is all underway. And these may or may not be visible on the chart, but we will discuss later about how those will be visible on the order flow. Now, people do also use order flow to scalp. I'm not a great fan of scalping. I'm kind of more of a laid-back trader. One of the key things to keep in mind about scalping is that trade location, context, and correlated markets are extremely important. It is not just about order flow. So people aren't switching on their trading PCs, seeing something on the bids and offers, and then just hitting into the market without considering the sort of overall activity in the market, as well as what may be in the moves and obvious hurdles that might be in the way in that market. Now, there are two major components to order flow, and we can separate those in terms of intent and actual. So actual would be what actually trades in the here and now, and intent is what people say they're going to trade, but they might not. So of all the order flow tools, it's only the depth of market and also Jigsaw Auction Vista that's going to show intent. So as a position day trader, you can actually get away without looking at the intent. Okay, so that's right. For many traders, the market depth is not that important. Now, as a scalper, the intent is much more important, but the actual executions, what's really trading, is still much more important than the intent. So what the intent tells you is that people are interested in a level, or people are trying to play a level. And a lot of the time, as you know, the bids and offers are fake or spoof orders placed to make the market look weaker or stronger than it is, but it still tells us that it's an area of interest. Now, that practice has been outlawed in US futures markets, but it's not very easy to police. Plus, when they have policed it, they've really taken out just the small fry. So it's not really outlawed, this idea of bidding, spoofing, manipulating the market. It's not really been outlawed to any realistic extent. But the fact is, if you see bids and offers really high in an area, it does not mean the area will hold, but it does mean it's an area of interest. Now, it's worth noting that when the market gets into a tight range, such as summertime, Christmas periods, maybe a couple of days last week we had tight range, you might have to turn yourself into a scalper to some extent if you actually want to play that range. I mean, you've got other choices available, and at that time, the intent does become more important at the extremes. Now, the use of actual trade information is what people talk about when they use the term tape reading. And at the end of the day, what tape readers are trying to evaluate is right here, right now, what is going on? Where are other traders positioned? Did we see a stop run? Is one side now in pain and holding back? Is one side trying to aggressively trade into stops? Do we have one side dominant in terms of order size, but no longer getting any price movement for their efforts? Is there an imbalance in trade? These are all things that order flow will tell us, but a price chart won't. So price charts simply tell us where we traded. Order flow tells us how we traded it and who is likely to still be in position and what reactions might be imminent. Now, in terms of perspectives, when you're looking at price action, you have a lot of people that will use higher time frame and lower time frame charts. But with order flow, it's actually the different tools that give you a different perspective on order flow. So for me, I like to use the cumulative delta to help me set bias and also gauge kind of the strength of a pullback. But I would never use cumulative delta to enter a trade. So you can put the cumulative delta on any time frame chart, but it's really the way they actually present the information that gives them their own unique perspective. And the way I put this is, the higher level, the longer term are the cumulative delta, volume profile, auction vista. Medium term, zooming in a little bit, cumulative delta, volume, footprint charts, I consider those are more medium term order flow tool, tape reading tool. The shorter term, again, volume, but from a slightly different perspective, footprint charts, market depth, time and sales. So those are kind of your short-term tools. It doesn't matter, well, in fact, you don't have a time frame with market depth, but it's very much the way they present the information. But they are all presenting the same information for the same reason, and the reason is all related to why price moves. Okay. Now, why does price move might seem like a bit of a daft question, but it is absolutely key to understanding order flow. Now, if you ask somebody why does price move in a market, you can have different people giving you different answers. Now, when I say why does price move, I don't mean why are people buying here. That is a completely different question. I mean, why does the price actually move up and down? Now, some people will say it's because there are more buyers than sellers, but the number of buyers is always equal to the number of sellers. Because the function of the market, the exchanges, is to just match up buyers and sellers. The market or the exchange doesn't buy off you. All it does is sits there and matches buyers and sellers, and if there's not buyers and sellers, a trade's not going to take place. Okay. Now, in a way, that could have you thinking that order flow is actually complete nonsense, because why analyze the flow of orders when every buy is also a sell? Because, you know, you could think of it, one would really cancel out the other, right? Now, another answer to the question, why does price move? A lot of people say supply and demand, and maybe that's closer to the truth, but not really in the traditional sense we look at supply and demand in traditional marketplaces. With stocks, there is an argument to say that scarcity or lack of shares can drive up prices, and that certainly does happen. But with futures, there is actually an infinite supply of contracts. With stocks, you have a float. There is a finite supply of shares. But with futures, there's an infinite supply. So what happens is contracts will get created and destroyed as necessary when trades occur between two parties. Now, another answer would be more aggressive buyers and sellers, and that's probably close to the truth, but perhaps less patient buyers and sellers would actually be a better way to look at it. So perhaps a better question we should ask ourselves is, what stops price from moving? So why is it that the S&P 500 futures doesn't trade at 2100 1 second, and then 1260 the next second, and then 500 the next second, and then 5000 the second after that? We know that doesn't happen. And the answer to that question, why does price move, or why doesn't price just jump everywhere, or how does price move, is also the key to reading order flow. And liquidity is the key to why price moves, or rather the consumption of liquidity. Now, what is liquidity exactly? A lot of people get confused by that term. Liquidity simply, it's first of all, it's the opposite of volatility. So if you think about liquidity and volatility, they kind of sound similar, but basically more liquidity means less volatility. Less liquidity means more volatility. So it's kind of the opposite of volatility, but basically liquidity is simply the availability of the other side to trade with. So if you want to buy, you need a seller to sell to you, and the market itself doesn't sell you shares or contracts. It just matches buyers and sellers. So when you trade, you are either providing or taking liquidity depending on the order type. So if you buy at market, then you buy from a liquidity provider on the sell side. Okay, and those are the people with sell limit orders. If you sell at market, you are going to sell to a liquidity provider on the buy side, and he's the guy sitting there with bids. So liquidity is limit orders, it's bids and offers, and for a lot of you, it's going to be your eyes kind of glazing over when I use that kind of terminology to explain how it works. Because, you know, for a lot of people, we're talking about liquidity, volatility, bids, offers, and sometimes ask, it all sounds a bit confusing. So we're not going to do that. We're going to just look at an analogy, and the analogy is of floors and ceiling. Okay, so here we have a building. It was designed by me. Unfortunately, there are no stairs and no elevator. So let's just imagine this building is the market, and we're now on the top floor. We have a ceiling above us, and we have a floor below us. So to move down to the next floor what do we need to do? Well, we need to break through the floor below. And the market does exactly the same thing. So the floors and the ceilings are limit orders, and these limit orders need to be consumed or eaten or broken by market orders before we can move through the level. So to move down, we need to break through or eat through the floor, and to move up, we need to eat through the ceiling. Okay, so now we've eaten through the floor, we've broken the floor, sell market orders have eaten the buy limit orders, and we have dropped down. Now, at this point, have a think, what do you think is easier now? Is it easier for us to move down or move up? And the answer is, it's easier at this point to move up because there's a big hole in the ceiling above us. Okay, so we broke through the floor, okay, which obviously if I look up, it's not a floor I see above me, it's a ceiling. Okay, so right now there is nothing to eat above us, and there is something to eat below us. I've got no ceiling above, I've got a floor below, and this is very important. Okay, now the ceiling has been repaired, so it's no longer easier to go one way or the other, and this happens all the way down. Okay, and in the market, here's your liquidity. So here are your floors and ceilings, the bids and offers. So we have the bids on the left and the offers on the right. Now some people will say asks instead of offer. Some people will call them resting orders or passive orders instead of limit orders. Okay, but it's just bids and offers. It doesn't matter what you call them. It's floors and ceilings. Now it's worth noting at this point, right, another thing we have to think about is that markets don't have a current price. Okay, they always have two prices, a buy price and a sell price. So in this image, if you wanted to buy at market, you would pay 2073, and if you wanted to sell at market, you would pay 207275. Okay, so when you look at a chart and you see the price, okay, that price isn't what you'll pay if you trade. That is simply the last price it traded. It's history. Okay. Now, despite a lot of the resting orders being fake, we still have to get through them. Okay. So if we look at the blue numbers here, we can see the number. The blue numbers here. We can see the number of contracts it actually took to break through the ceiling. So here we can see we traded 17 contracts and we ticked up. 95 contracts ticked up, 10 up, 64 up, 25 up. That's how many contracts it took to eat through the ceilings or eat through the offers. And that is really an indication of how much depth was actually real. So if we look at the offer size here, you can see 75, 81, 103, 89, 113. But the actual trade side, 17, 95, 10, 64. So you can see the difference between the amount of depth advertised and the amount of depth that actually took to trade through that level. Okay, so with the order flow, with the tape, you're getting an indication of how much depth was actually real. So that's how you compare intent and actual. Okay, so that here, the tape, is what really happened. And we'll get into practical application, how to use this information shortly. Because it's important to understand one other thing, and the other thing that's important is to understand where liquidity is and where it isn't. Okay, so on the buy side, the floors, there is liquidity below you, and there is liquidity below the 10 you can see, but your data provider doesn't give it to you. It doesn't mean there's nothing down here. Okay, the stuff down there, you just can't see it, but there is no buy side liquidity. There are no bids above the current price. If you put a bid in anywhere there, it will turn into a market order immediately. It'll become an actionable order. Okay, so there is no buy side liquidity above the current price. And if you just think about it, you've never looked up and seen a floor, right? So there are no floors above you. On the sell side, the ceilings, there is liquidity above you. There is liquidity all the way up here above what you can see, but it's just not visible. Your data provider doesn't give it to you. But there is no sell side liquidity below the current price. It's impossible. And that is very important. What it means, as we move up into areas where no floors exist, but where ceilings do exist. Okay, when we move down into areas where no ceilings exist, but floors do exist. And that moves up means that in a move up, you get a relative liquidity vacuum created behind you. So as we move up through this area, simple fact is it takes time for the floors to build up in the wake of that move. And in a move down, there's a relative liquidity vacuum created above you because it takes time for the ceilings to build up behind you. And spotting those liquidity vacuums where price pullbacks because of a lack of liquidity and not because of counter-swing trading represents opportunity that a lot of traders really aren't aware of. Now this is another way to imagine the liquidity picture. Bids getting thinner and thinner as we move up, and offers getting thicker and thicker as we move up, and bids getting thicker and thicker as we move down, and the offers getting thinner and thinner as we move down. Which brings us to another important point. At an area of resistance, right, generally speaking, the ceilings will be very, very thick, and the offers or the ceilings will often be 1.5 to 3 times the bids. In fact, if you're not sure whether a level you're looking at is one that other traders see as resistance, that alone will tell you. Okay, so as you get to resistance, the offers will very often be stacked. But the thing is, that does not mean that the level will hold. Okay, it's the same at lows with support. The bids will be stacked at any valid support level. Now again, does not mean the level will hold. It's just kind of one of the quirks of the market. It's just the way the market works. So very often, as price gets right close to those thick floors and ceilings, they just suddenly pull out of the way and the market moves straight on through. But it is a good indicator. So if you're looking at the way you analyze the market and you're looking at a market moving up to one of your key levels that you've got from your analysis and the bids and offers are absolutely normal when it gets there, then it literally is just you. It's just you looking at that level. And you've got to look at levels that other people are looking at. You know, one of the concepts that you hear from, you don't hear it so much now, but you know, one of the concepts you used to hear in trading and trading education was people selling secret levels. And the fact is that if a level's a secret and not many people know about it, it will never hold. Okay, it has to be an area where a lot of people are engaging for something significant to happen. Now that's the end of the theory part. We're going to look at why this is relevant. But just remember to recap, at any time the market does not have a price. It has a floor price and a ceiling price, which is also known as the inside bid and inside offer. And there's a minimum of 1 tick difference between them, and that difference is also known as the bid-offer spread. Market orders consume buy-side and sell-side liquidity, also known as limit orders and also known as floors and ceilings. And when there's no more ceiling to eat, more buy market orders will start eating the next ceiling up and price will move up with it. And all order flow analysis is basically a variation on this thing. As you move up, a relative liquidity vacuum builds behind you, and often price momentarily collapses into these vacuums before continuing up. And these vacuums present short-term trading opportunities. And it's why you see very often when the market pulls back, the cumulative delta that's shown you kind of net bids minus net sells just stays flat. It's because the market's falling back because of lack of liquidity, not because of sellers engaging. Now, different traders work on different time horizons, taking different amounts of time to fill those vacuums. And what we see is, as we move up, lines in the sand in the form of higher volume areas will build up behind a move. And this is often what ends up supporting price as we move up. So you should always have your eye on the rear view mirror when you're using order flow. Don't just look ahead for obstacles. Look behind you for these liquidity vacuums and these high volume areas that are really good opportunities, really good lines in the sand, and much better trades to take than these, trying to sell the high of the day and buy the low of the day. Okay, well, so what? This is all theory so far. How do you actually kind of turn this into something you can, turn into action? And what even is the benefit of understanding this liquidity consumption model? So let's think about the implications of what we've gone through so far in terms of things that we regularly see in the market. The first one's spikes and churns, or rapid moves up versus slow grinding moves up. Now, most people will see a fast, rapid move up and they will think that is a strong move. That's strength in the market. But if you think about that liquidity consumption model, you'd know that when you have a rapid spike up, that's actually going to create a larger vacuum, a larger liquidity vacuum behind it, right? And that is actually a sign of weakness. On the other hand, a market that just kind of slowly grinds up all day often gives us the impression that the market's weak. It's just kind of crawling up. It looks like it's going to stop any second, and we end up missing a 50-point day on the ES where it just churned up. Now, that grinding action is actually a sign of strength because the slower move doesn't get the same sort of liquidity vacuums built behind it that a rapid move would. And with less vacuums, you also have less reversal traders jumping on the pullbacks thinking they're reversal. So what tends to happen is, when a market starts to pull back, everyone's like, oh, sell, 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 the market's finished, it's not going up anymore. And of course, those are the guys that get caught out and actually help kind of the next move up. That tends not to happen on a grindy day. So grinding moves are obviously signs that the market actually likes trading at successively higher prices. So we've all seen markets grind up, waiting for a pullback that just never happens. And those grinding moves can be really frustrating to trade because there's that lack of a pullback. But if you don't see that action as strength, if you see that action, that grinding action as weakness, it makes it really, really difficult psychologically to just actually jump on board that move with, maybe a small position and build up as you continue, okay? But if you understand this grinding move is not causing a lack of liquidity behind it, you actually know it's a safer bet to actually just join in that move. It's not likely, probability-wise, it's less likely to just suddenly spike back on you, okay? Now, retracements or pullbacks can be spotted by a lack of participation in the counter trend move, okay? Which generally means low volume on the pullback, and also the delta or the difference between the sell market orders and the buy market orders is very small, okay? We're not moving back because of a lot of selling, okay? So a market might move down in an uptrend, but if it's because of a kind of general lack of liquidity, the volume, the cumulative delta will not be significant in the move. And part of the reason the markets have a tendency to stair step up is that it takes time for the liquidity to fill in the wake of a move. So, of course, we also get these perma-fader traders who can't stop themselves from selling every move up and buying every move down. As for the end of a move, well, most trade days are driven by intraday speculation. And for these daytime buyers, once they are in position, they are now people that have to sell to unwind. So as you move up, you are gathering more and more future sellers, and you eventually get to a point where people, need to offload. We actually need to kind of shake off some of those sellers before the market can continue moving up. And sometimes that in itself is enough to trigger a reversal, but a lot of the times it just triggers a pullback. So we have liquidity, and we have market orders that consume liquidity, and order flow is all about that process of liquidity consumption. But whose order flow is it we're looking at? And how important is it? After all, there's a lot of different types of participants in the market, and they all impact the market in their own way. And what we're going to cover now is probably the opposite of what a lot of people are saying, and it will probably sound counterintuitive. So I'm going to simplify this a little, because we could, really talk for hours discussing the nuances, but we'd still come to the same conclusion, which is that the higher the trading frequency, which is the more frequent the trader, the lower the impact on the market, okay? And this is important because the participation in the market changes day to day. There aren't many days where long-term institutional repositioning is driving the market, Okay, my experience, way less than 1 in 10 days. Yet these traders have a massive impact in price, often generating one-way days. So if you think about it, major institutional positioning, these guys here, as investors and funds, are the least frequent traders, but they have the highest impact on the market when they are trading. On the other hand, okay, the highest discount at the CME on the S&P 500 futures is for traders that trade 135,000 contracts or more per day. Yet those high-frequency traders have the lowest impact on price if we exclude the sort of hiccups caused by the occasional flash crash. So why is that? Well, an HFT is going to buy contracts and very quickly sell them. So any impact their buying has is negated very quickly by their immediate selling. So if anything, they actually help to stabilize price, make price less volatile, because they provide us with, with liquidity. So these guys down here, they kind of act as stabilizers on the market. But a large fund initiating major repositioning or even hedging, they'll be trading in one direction. Remember, I'm simplifying things here, and then holding for months or years. So on a day where that's occurring, they might be buying for hours and hours to achieve the adjustments in position they want. They could even be doing that over days or weeks. And in all that time, their trading will be predominantly one-sided. And if you're only buying and you're buying a lot of contracts, then that will impact the market much more than somebody that buys and sells and buys and sells and buys and sells an equal amount. Now, in the middle, we have swing traders who have shorter holding times, usually days and weeks. And then we get onto day traders. Now, position day traders are those that try to take advantage of major intraday swings, so often staying in positions for hours. Scalpers are generally in and out of the market, just looking for a few ticks. And then HFTs are mostly short-term, market-making arbitrage trades. Now, you may have noticed on the majority of days, most markets put in decent-sized swings in both directions. Okay, they're not directional. They're kind of, ES might go up 10 points, down 15 points, up 14 points, end up settling pretty much where it started. But did you ever really stop to think about why that is happening? So did a fund manager at Fidelity wake up feeling, the economy's great, but at lunchtime he got second thoughts and decided the outlook was really gloomy? Is market sentiment really changing multiple times a day? Well, no, it's not really. That's not what's going on. What is going on is that speculation is pushing the market in one direction. But as we said earlier, when a market is moving up, speculators will eventually have to sell to take profits. And in addition, when a market is moving up, at some point, traders will just simply have built the position size that they're comfortable with and just not want to add more contracts. So you effectively run out of short-term speculators initiating new positions for various reasons. The market slows down as you run out of buyers. And then the people holding long positions need to take profits, see the slowdown, something just gives them the jitters, tells them now it's time to get out. They sell off, market moves down. People with no position, or maybe the guys who were long and now are flat, they're going to then see opportunities to the short side, and that people jumping on that move sort of snowballs downwards, and that cycle repeats itself over and over again, and the markets swing up and down. And this is the cycle that a lot of smaller traders are trying to take advantage of, even though they really don't think too deeply about what's really going on. Then, of course, we have days where we get big increases in volume, and we know that the big boys are playing the market and, the larger institutional positioning. On those days, speculation isn't dominating the market, and the market does behave differently. And that's important because as a trader, it's the actions of the people in the time frame similar to you and above that will have the most impact on trade. So if you're a scalper, the people who are going to have the most impact on your trade are all these guys here. If you're a position day trader, the people who have the most impact on your trade will be these guys here and the other position day traders. Now, right now, there are so many traders focused on trying to read HFT activity that they lose fact of the sight that these are actually low impact traders. So it's much more important on any given day to know if large institutional volume is driving the market, or if short-term speculators are driving the market, or if overall uncertainty is keeping both out of the market. And if you look at what we had last week, we had some great range days, and then we had some, fairly horrible days. Yesterday we had a big day. Speculators decided they want to play it today. Today, wasn't very good. It was very, very, we just saw, a lack of participation. There's things that can, give us a clue when that's happening. The VIX index, when that spikes, liquidity decreases. What we see then, there are times when HFTs, do participate to a lesser extent. Like I say, when the VIX spikes, liquidity decreases, the volatility increases, and the market can be a wild ride. But what you're actually seeing there is more a lack of participation in the time frame below you, and so you've got less liquidity to lean on, and the market gets a little bit hairy. Now, of course, new traders would love to be able to pull up a 1 minute chart, slap on a couple of indicators and trade off it without worrying about all this stuff, okay? But this detail, who's playing the market today? Is the volume above average? That is the market, okay? That is the market, okay? And that detail, it's key to understanding the context of the moves that you're seeing on any one particular day, okay? It's not just about candlesticks. It's, you have to understand who's playing this market today. Is there a reason that's brought the investors, the funds into the market, some big news events? And is that followed up, with a lot of volume in the market and directional move? Yeah, it is, okay? Well, I'm going to try and go with that move then, because I know it's probably not going to, it's probably going to be a one-directional day. Or, have we been sitting in the same range for 2 weeks? Yes, we have. Is there any news? No, there isn't. We're probably going to get a bit of a lackluster day, because there's really nothing for, the shorter term traders, the day traders to kind of, take their cue off. Now, following participation in terms of increase and decrease in volume, as well as the news that could cause the change in volume, isn't particularly difficult. And neither is keeping your eye on the dome to look out for, increases and decreases in liquidity, and increases and decreases in the number of limit orders on the dome, which is kind of an indication of whether you do have less market making going on, whether, maybe some of the HFTs are switched off. But it will absolutely benefit your trading. So price charts will tell you where we traded, but won't necessarily tell you about the shifting state of the market. So now we have a feel for the theory of order flow. We've also kind of touched on some other things, volume-based things, and who's in the market and who's going to affect the way the market's going to move. So let's consider the implication of our order flow model when it comes to reversals. Now, when I talk about reversals, I mean major reversals and minor reversals. And the thing about reversals, you've also got to remember, if you're looking for a reversal and that fails, and that really was a significant level, then you have a slightly different kind of trade, a go with trade, okay? The other thing you need to know about reversals is that just because you see a reversal doesn't mean you have to take a trade, or just because you're looking for a reversal doesn't mean you have to take a trade. It just kind of helps to set, a lot of times, just kind of helps to set your bias, okay? So when I talk about reversals, I'm talking about major reversals and minor reversals. So major reversals initiate a new move, and minor reversals are basically your pullbacks, because now, based on what we know about liquidity and liquidity being consumed, we can talk about just 3 elements that will cause reversal. Now, not all reversals have all 3 elements, but all reversals have 1 or more of them. Okay? Now, the market can only reverse with these 3 elements, and without them, it is not possible for the market to change direction. So, generally speaking, most traders are looking for the market to change direction, whether you're looking at because the market broke out of a zone and is now returning to it. We're generally looking at some sort of reversal. So we have just 3 elements that will cause reversal. Okay. Now some of those are easier to spot in the order flow than others. So let's consider them one by one. And what we're going to do, for the sake of simplicity, let's just consider long to short reversals and presume it's the same for short to long. So the first element of a reversal is something called absorption. And this is where the buying continues, but the ceilings no longer break. Okay, so the ceiling will either be too thick Or as buying consumes the ceiling, more limit orders come in and kind of build that ceiling back up before it can be consumed. Now, this rebuilding the ceiling as it's being consumed is what's known as an iceberg order. Now, in terms of being easy to spot, this is absolutely the easiest. Okay, it's kind of it's just right there in your face. You can't miss it. It takes time to do. You know, on the S&P 500, the absorption will take place over minutes. If you look at crude, it's slightly different. It takes place over a series of prices. Okay, but still, you can see it. It's very easy to see. What it means is basically the offers, the ceilings, the sellers are stepping up and absorbing all the buying. The buying is no longer able to move the market, and eventually the buyers, especially the late buyers, if you imagine you're buying and buying and buying, yeah, you're joining in this market, you're a short-term speculator, you're buying, it's going up, I'm buying, market stops moving up. Now, it doesn't matter, let's say 3,000 contracts, bought into that level, which would be common on the S&P 500. It doesn't mean all 3,000 have to be short-term speculators, okay? It just means that enough of those 3,000 will be short-term speculators that when they realize they're trapped, that their buying is no longer able to move the market up, there's enough short-term traders there getting out that will help to start to trigger reversal. So in some cases, when that happens, you will be able to join the offers, but it really depends on the market. So on the Treasuries, S&P 500, joining the offer is sometimes very difficult when there's an iceberg order. It kind of depends on the type of iceberg. S&P 500 very often will leave you without a fill. Some Treasuries traders I know, they manage to get good fills with limit orders. Crude's a slightly different matter when it comes to using limit orders, because when you enter on a limit order with crude, you would do so because you're trying to take advantage of the volatility. So we won't cover that here. We will cover it a little bit later, because when you have a volatile market that's moving around 7 or 8 ticks at a time, if the conditions are correct, then you don't actually have to wait. Don't have to actually get in immediately. Okay, you can actually let that volatility sweep you in, but it is a particular type of entry. The second sign of a reversal is buyers fading away. And this is where you get to a price and nobody wants to buy anymore. And sometimes that's a gradual change. So you might say 1,000 contracts trade, we tick up, 600 trade, you tick up, 300 trade, you tick up again, and then 45 trade, and we're done. Other times, you have regular trading at one price and you tick up and there's just no one there at the next. So ultra thick markets like the Treasuries often just hit one price once. The S&P 500 will tend to go to a level a couple of times, and each time either no contracts or a very small amount of contracts will trade. In fact, the S&P, a lot of people know the S&P as the second chance market, because you've often seen this. You get into a trade, it's not working, it moves against you, it comes back to your entry price, gives you a chance, you don't get out, and then it moves against you. It also does the same thing on the entries. It tends to move to a price, trade a little bit, move away, go back to the price. It's just really a matter of kind of understanding the personality of that market. Now, this is fairly easy to spot, but quite often you don't have the luxury of time to react as you do with the absorption. And also there is a fact that markets do pause, so you need to be looking for this kind of buyers fading away at a key level, okay, or at a reversal, okay, at a pullback, because spotting the buyers fading away when the market's already in a weak pullback is much easier to do than when it occurs on a full reversal. Okay. Now there's also a time element to this, because it kind of does take time for the buyers to realize that nobody else is buying anymore. So you will quite often see it will go up to a price and it won't trade it. It'll come away, go up to a price, won't trade it, and then everybody sits there looking at it, and eventually it's like, no, there's nobody left there. And then you start to see people unwind, and you'll start to see the sellers coming in, which is the third element of reversal, the sellers coming in or the market rolling over. And this is where you don't so much see buyers fade away as you just get to a level where sellers start hitting aggressively with size. And many times this will be after the absorption or after buyers fading away, but other times it's just going to come out of the blue with no warning, just suddenly market bit going up, not, quite happily markets going up, all of a sudden sellers come in out of the blue with no warning. Now, you're most likely to see, when this happens, sell market orders are going to be 2 to 3 times the quantity of buy market orders. And this is, it has to be said, hard to spot in a timely manner. In other words, by the time you spot this, the market will have ticked down a few ticks. Okay, it just depends on your market. It might be 6 or 7 ticks on crude, might be a couple of ticks on the ES. And at that point, you can decide to get in at a worse price, but more confirmation. Effectively, what you're doing at that point, you're trading a good price for certainty. It does not make it a worse trade. It's just a different trade, okay? So if you see the market go up, or you get the absorption, and then you see the seller step in, and you've got decent size on the sell side and not much on the bid side, and you're at a level, and the market's pulling back to a place you think it should pull back, that is a good trade. That is a good signal off the order flow. You're giving up some money on the price. Again, you're probably not going to get an unlimited order then because the market's already starting to move away, but you've got a bit of additional confirmation. And a lot of traders, they kind of get really hung up on nailing the reversal to the tick and not getting in if they don't. And it just means sitting on your hands a lot of the time. A lot of the time, waiting for the sellers to come in, it just means you have a lot less losing trades. Now, this seller stepping in will help you confirm a short trade after the event. So there's no law that says order flow can only be used for order entry. Okay, so order flow is a great way to confirm a trade is actually going your way and that you should hold on to it. So you differentiate between the price moving your way or not and the order flow moving your way. Okay, so you might be onside a few ticks in your trade, but there's no imbalance. The sellers and the buyers, they're about the same. There's no excitement in the market. The market's just kind of milling around. Okay, that's one of the trades where your kind of position's at risk. And similarly, it's a good way to tell, if the order flows against you, price might be actually with you. You might have moved down 5 or 6, but now the order flow's coming in against you. You might decide to get out, just keep a couple of ticks profit. Now, just to reiterate, these elements of a reversal are not mutually exclusive. You will see one or more of them with any reversal. So let's look at reversal in the S&P 500. Now, on the left, we've got the Auction Vista chart. Just to run over that for people who don't know it, the yellow lines show us basically where we've traded. The offers are above in red, with the larger offers lighter colours. The bids are below us in blue, with the lighter colours, example here, being the larger bids. Then we have these circles, which show us where exceptional size is trading over time. Okay, over time. It's not a snapshot of, in this instance we had size. It's whenever we gather volume, whenever we get that absorption event. Could be 2 minutes, could be 2 seconds, but it's over time. Up on the right, we have the jigsaw depth and sales. We're not going to go over all the columns now, but we can see the bids and offers. And between that, we can see how many market orders have traded into those bids and offers this time round. On the far right, we have a jigsaw reconstructed tape. That's just showing me orders of 50 contracts and more. And up here we have a meter, just got one on the left, showing sell market orders in red and buy market orders in blue. Now the volume profile shows us that so far, this is quite early on in the day, the market's balanced. It's a very low volume start to the day on this day, low participation in an area where there was generally a lack of conviction overall. So this was, I believe, in the early part of the summer holiday this year. So we're in an overall area where basically we're in the summertime, we're expecting low participation, the day opens slowly, the liquidity is fairly high. We look at that big picture and we say, we're not going to get 20 points today. Okay, the trade today is to fade the market, fade the range, or just go and do something better. Days like this, sometimes maybe you just don't want to trade. So this is a low volume start to the day. We come down to 21.10.25 and we see a massive amount of trade. So we can actually see we got more than 5,000 contracts traded overall into the bid. Now, why does this show 2200 and this shows 5000? Well, effectively, we came here and kind of hit into it a couple of times. And like I say, this 2245 just shows me this time round. Now, we can also see a really big circle here on the Vista chart. Excuse me, just drink a cup of tea. No, not a whole cup, not that fast. This shows the size trading. The size that we traded at this level is much bigger than we traded anywhere else. The circle itself is bigger. And we can also see the balance of trade slightly balanced towards the buy side. Okay, not really that important today, the imbalance. Excuse me. Now, as this is a low volume market, we're expecting range bound behavior. So contextually, we're already looking for the market to hold at the bottom of the range. Okay, so we've been up and down a few times already. We're at the bottom of the range. We didn't actually get to the low. We were looking for the low. We didn't get there. We saw the sign, we saw the absorption, and this is just an example of a reversal in an area, approximate area, but it's kind of reversing earlier than we expect. So we're also at the lower value for the day, okay? And market auction theory tells us that value is where 70% of volume traded. Again, that's a simplification. That's what this orange area represents. I like to use it simply for one factor only, is that I know a lot of other people use it. So I know there are kind of people looking in that area. Therefore, it's an area I want to keep my eye open for, because if I believe that a lot of people are going to participate in an area, then that's kind of where I want to start looking at the market. Now, with all of these trades here, okay, these 5,350 that are sold into that, we're going to have a lot of people positioned in this location. Many of those are going to be short-term traders. And as we move away from this area, whether we move up or down, traders on one side will exit their positions. Now, as we're looking for a long off the bottom anyway, if we move up, the shorts are going to have to buy to exit their positions, okay? And effectively what we're looking for the move up and for the shorts to buy to exit their losing positions, and that is what we call a stop run. And that is what we want to take advantage of. We want to take advantage of the market popping. Now, if we buy here, because of the location, already been at the value low, already been on a slow day at the bottom of the range, we stand to get a decent pop up, and decent relative to the day, which is 21.12 perhaps, if the market starts to move our way. Okay, so we've got context. We know other people are going to be looking at this and bailing out if they're short and the market starts to move up. But on the other hand, if the market starts to move down, we really only need to allow a few ticks below this area of high volume for our stop. So if it moves down to 0950, we know we're wrong, because we're moving then into an area where the long traders would be getting stopped out. So a trade like this, honestly, a lot of the time, it wouldn't matter whether you went long or short, because your stop is basically closer than where your eventual target would be, because you're basically trading off. You're leaning on the amount of volume traded at this price. Now, we did enter a trade at 10.50, but remember, this is a low volume, low range day. We wouldn't be looking for a 10-point trade on a day like this, okay? We're using lack of participation to judge the state of the market and decided it's probably not going to be a big range. Now, if this was the start of the day and I was expecting a big range, I'd probably take 2 off here, or maybe 2 off at 214 and try and scale out of the position. But obviously, we're not expecting that, so let's just take a quick look at what we can see. So we can see that the market, after we got in, we didn't trade below the circle, that area high volume, it held. We can see from the angle of ascent here, the way it moved up, that we did indeed get a fast pop, and that's indicative of the short-term traders, short traders that engaged in this area getting stopped out. The stop runs happen quickly, so we do see that move up. We can see the size of the trades executed on the way up on the buy side is much larger there than on the sell side. So we can also see the meter, which reset when we entered the trade, is in balance to the buy side to about 2.5 to 1. And this is typical of a strong push up to see market buyers outnumber market sellers to 2.5, 3 to 1. And we can also see on the tape that the large traders are mostly on the buy side. So this is a reversal where we had absorption and then we saw buyers step in, some because of stops and some because they did what I did, started buying when they saw the trap on a low volume range day. Now this is not trading a pattern, okay? This is trading with a knowledge of other people's positions and really knowing where you're wrong and where you're right and why. Now here's an example from crude oil. Now the first thing you notice with different markets that have different liquidity, crude is a much lower liquidity market. So when we look at the circles here, the area where we have exceptional size, there's only 146 sells and 233 buys, and that's a lot smaller than the 5,000 contracts we saw in the previous example. So crude is a lower liquidity market. Remember we said liquidity is opposite of volatility. So it's less liquidity, more volatile. So seeing 1 or 200 contracts at a level is actually quite significant. Now once again we see absorption here, and then we see buyers come into the market. This area then becomes something we call a hidden backstop. So that's an area which is significant from an order flow perspective, but wouldn't necessarily have to be significant from a price action perspective. So, we might be looking at this and looking at this area here and saying, well, that could just be a pullback. Is there anything significant about that? Yes, there is something significant about that. The kind of volume that we washed through, we got some absorption here, some absorption here, some absorption here, some absorption here, and then we washed out through all of those prices, okay? So that makes that area significant. Excuse me. So that area then holds the market later on. So we have two moves down or two pushes down to that price, but in both cases there, that reversal is more a case of sellers fading away. There's not absorption there. We just get there and people just didn't want to sell into those prices. Now think about why would that be? Because we've said, this is all about people, all about people's positions, it's all about behavior. Why would somebody not want to sell past this circle? Well, if we think as a circle, as the bottom of an area where both buyers and sellers initiated new positions, okay? So we know this is the biggest circle. It's an area where, every buyer's a sell. So we've got buyers and sellers there initiating new positions. The sellers ended up losing money, okay? The buyers are quite happy. So when we return to the area, it's only natural for sellers to feel a bit uncomfortable selling where they or other sellers just lost money. So as we come down, we see a lack of willing on behalf of the sellers to sell down through that area. And that's one of the reasons that intraday volume profiles, footprint charts, anything that shows you where a lot of volume occurred is very significant. I don't mean, volume in 5 minutes. I mean, what price did we just trade a lot of volume? It's very significant from a psychological perspective because people just don't want to, you get back to an area where somebody lost money, they're not going to do the same thing again. Now we can also see on the way up, we can see that buyer liquidity builds below the market. You see all this liquidity here, all these bids here, which lots and lots of people can see. A lot of people are trading off the dome, which again is something that could also put people off selling down towards that area. Now this could just be opportunities traders, looking to buy the market at good prices. We also see additional liquidity around price as we move up and down. Now this is where you're most likely seeing HFT, market making activity, just trying to pick off bad traders or play the spread. So if you think about it, on the way up, smart traders should be buying. So if somebody does sell to a market maker, it's easy money, basically. It's a very low risk trade for a market maker and a bit of a silly trade for the seller. So that's what you see, especially on these markets that move away a lot. We see a lot of market maker activity, around the move. Not really that much, you go out a couple of prices, 3 or 4 prices. There's not really a lot there, but basically it's a more volatile market, different kind of opportunity to kind of allow yourself to get swept in by the volatility and do a bit of market making. And that is the basics of order flow. That's the process of reversals and a couple of examples of components of reversal. Now, you've got to remember the goal here was not to make you an expert in all aspects of order flow. Webinars 3 and 4 are going to take this into advanced concepts, but it's to give you an understanding of the concepts of liquidity consumption, participation, and the reversal process. And that brings us to a close. So if you've got questions, now is a good time to type them in. Reading order flow does require the use of discretion. It's like reading a story. So that doesn't mean you trade without governing rules. It just means that every situation is a little bit different, but the overall patterns are recognizable with practice. But got to keep in your head positions, participation, other traders. Now, it also doesn't mean that discretionary approach is particularly difficult. There are a lot of people that really want to trade mechanically. They want to have a fixed set of rules because they think that is easier. And then they go away and they spend 10 years playing with indicator combinations, trying to find that fixed set of rules. So don't be scared of using discretion in trading. It's what most professional traders do, and it's no different from using discretion in other things in life, like driving. We don't drive mechanically, we drive with discretion. That's the tools you saw today. As you all know, these are part of the Jigsaw Trading tool set. We're getting close to 4,000 users now. We didn't show all the features of the tool today. We're just laying the groundwork for understanding the benefits of order flow, and just to show a couple of practical examples. It's the understanding of the theory that we want you to take away from today. With that, you will get much more benefit from the third and fourth session in this series. Now, there's a lot more information on the Jigsaw Trading website. There's a lot more information on the Trading Framework site. There's many hours of free training materials covering a lot more in-depth information on order flow, trade management techniques, volume profile analysis, intermarket analysis, much, much more. There's a lot to this, but the most important thing, as we said earlier on, get the theory down, get some practical experience, and then pick up, if you are new to Jigsaw, the best way to approach it, go to the first video, the introduction to order flow, or watch this again, then get the practical knowledge, and then maybe do one video a week, just to kind of learn some of the more advanced concepts. There's no point in going through 10 hours of videos without any kind of practical experience. It's the practical side that will get you there. And there is a video that we've got which is called New to Jigsaw Tools that just kind of says, right, sit down, do this, watch this, and then you're going to start to see the story unfold. And that's really the way you need to get, really the way you need to approach this. You need to immerse yourself in the practical side. Okay, what I'm going to do is I'm actually going to go through the questions now, and I will just go back to the first questions. Apart from I can't see anything. Somebody's asking when and how are the floors and ceilings repaired? Well, basically, what happens is you move through the bids, and you move into areas where there are no offers. So you move down through the bids, there are no offers there, and then basically market makers, HFTs start coming in and making the market. There are people that are actually contractually obliged to make the market, and they'll be the first ones in. But they're not the whole picture, and then other traders will then start to come in after them, and it will just slowly fill in. It actually happens very quickly, but you still see overall these lacks of liquidity in the pullbacks. Last week's recording, it was sent out. If you registered, I will send that out, both recording links with an email this week. Okay, somebody's asking when the price is above the value area high and there's a large inside ask orders at the high of the swing or pullback or high of the day, how can you determine if it's a continuation or a reversal? Well, the bids and offers won't tell you that. It's basically, and that's one of the issues with being a perma fader, trying to take advantage of what I call major reversals or trying to find the high of the day, is that you will see big asks at the high of the day, and it's just normal. What you need to look at is, okay, when I get there, what do? Do they pull out of the way? Do they firm up? Okay, I get to that price, they're still there, it trades into them. Do they add more contracts? It's that kind of just being a bit more two-dimensional about it instead of just saying, okay, I've got big offers, it's going to reverse. So you have to kind of see what they do when they get there. What does it mean, LIS, on the depth and sales? LIS simply means a line in the sand. So when I trade, I don't look at levels in terms of support and resistance. I just look at it as a line in the sand. Okay, if it breaks, if the level holds, I've potentially got a trade. If the level breaks, I've equally potentially got a trade. If the level breaks that people were trying to hold, you've got people that are going to get stopped out, and that's certainly something you can take advantage of. Okay, delta, referring to the example of reversal or in general, is delta only the market orders or only the limit orders? No, the reason delta is so important is because it's just market orders. So it's buy market orders minus sell market orders. That gives us a delta. And because it's the market orders that are consuming the limit orders that helps price to move, that's why we're interested in the delta, because it tells us the imbalance between the buy market orders and sell market orders. So if we're generally imbalanced on the sell side and delta's negative, then that's going to be more selling eating the floors below us. Okay, so delta is just about market orders, and that's why it's important. Okay. Okay. Oh, good grief, my scroll bar's not working. Right. Where can I watch last week's video? We've been through that. Does price move in direction of least resistance or less resting orders? No, not necessarily, because a lot of the time what will happen is as you move to a level, they will add resting orders. It would be wonderful if it did. Quite often you'll see, if you watch crude, one of the things to look out for on crude is actually places where you've got extremes. And quite often you'll see, you might have 10 levels and you'll see 3 levels, where you've got 200, 200, 200. And what quite often happen, it'll actually go to the opposite side of those 600 contracts and then reverse back down. It'll kind of like move up and take them out. So it is market dependent, how the market reacts to size, but it is also just dependent on what they do when you get there, basically. Yeah, tools are more geared towards futures. We do futures. We do have people trading stocks. With stocks, the picture is a lot more disjointed. There are a lot more exchanges. You need data for a lot more exchanges. I was actually a stock trader before I started looking at order flow. The guy that I started looking at, basically, he said, if you start looking at this, you'll end up being a futures trader. I'm like, no, I just want to take it back and apply it to stocks. It's not a difficult transition. What I found as a stock trader, day trading stocks, I could spend 90 minutes before the day opened, putting together a watch list of stocks that I thought would be in play for the day. I might have to throw a bunch of those away before the open. Some of them might be dead after the open. I might get an hour in, everything's dead or everything's done. I'm now looking at a scanner, trying to scan what's going on. And I found I spent most of my time looking for what to trade instead of trading. With futures, it's a lot simpler. I mean, you basically pick your markets you want to trade, you watch those markets, you create your hypothesis, you get to know that market like it's a really good friend instead of picking, 10 for the day out of 6,000. And it's definitely a different approach. It's a lot less frenetic. If you need to be doing 30 things at the same time, you should do stocks. But I think there's a lot of upsides for trading futures. For Forex, we do have people trading Forex. Of course, there's no order flow on Forex. But what you'll find is like the Euro USD and the 6E futures, the Euro futures, tend to move at the same day, at the same time, certainly in human time frame. So arbitrage keeps the markets in line. So what a lot of people do is they'll watch the futures markets, but they'll maybe have an Oanda account because they're kind of new to the markets, and they'll be trading really small trades, trading the like an Oanda account, trading pennies, and watching the futures market. It's actually a good way to get into real money trading, as a beginner. What is minus development? I don't know what that means. D, if you can clarify. Do I use historical data to practice jigsaw? No, not really. I don't really practice it anymore. I've been using it. It's 5 years old. No, I don't use historical data. There's always a market to watch. There's always something to watch. If you're in the US evenings, there's mini Nikkei. You get into the Asian session, crude's taking off. get into the European session, you've got all the European markets plus the US markets taking off. Get into the US morning, you've got those markets taking off. I don't really personally, see a need for too much history. Right, volume as size and area, Tom's asking. I would go to the website, the Jigsaw site, and have a look at the videos on volume profiling using intraday profiles. Basically, the significance of size is a couple of things. First of all, it signifies absorption, but also it signifies an area where traders got stopped out. So if I have a 6 prices, trade like 300,000 contracts and move away from that area, and this is, Cam touched on this a little bit last week, you're looking at a slightly different way. If a lot of contracts trade in an area and I move away from it, when I go back to that area, that's where people got their fingers burnt. And if you think, if you just lost money somewhere, you're not going to put money, if you just bet on a horse and you lost money and he's the same horse in the next race, you're not going to bet on that horse again. Okay? We already talked about software can be used for stocks. How do we get some idea of resting orders? Not really sure what you mean there. It's on the dome. What you'll find is as you watch the dome every day, you'll get used to the average levels of resting orders. So you'll go into the market one day and say, oh, there's a lot there today, or you'll go in another day and say, there's not a lot there today, and you can kind of have some expectation of the volatility based on that. Auction Vista is part of 5.5. It's actually part of the depth and sales, so it's kind of embedded within the depth and sales tool. I have to scroll down again. We get into the end. I use both TradeStation and Sierra Charts with 2 different data providers. I see difference in the order flow data. Yeah, I mean, if you're using 2 different data providers, you will see different data. So there are some data providers that provide filtered feeds, which means the trades hitting the bid and the offer, you sometimes be on the wrong side. You'll see that on Xtrader feed. You'll see that to a smaller extent on Rhythmic feed. You won't see it on CQG. You won't see it on IQ feed. So IQ feed and CQG are the best in terms of matching trades. But honestly, with the amount of professional traders that have been using Xtrader, if that feed wasn't suitable, I would say it doesn't really matter to an extent which feed you use. You just can't use Interactive Brokers feed. That's the only one I would say I would draw the line at. I would personally use any feed except Interactive Brokers. In currency FX futures, I often see what looks like delta divergence. There's a simple reason for that. You will see a delta divergence if there's a lot more absorption, because a lot more people, getting in on limits. On a more volatile market, you'll see more delta divergence because you simply can take advantage of the volatility to sweep you into the market. And then, sometimes, market makers or people providing liquidity are in control. So that cumulative delta thing, it's not reliable on our market. It is market specific. Rapid Trader Pro is available now on alpha to anybody who uses Jigsaw. You just have to email us and ask for it. When it will be live, I would say end of December is what we're targeting. We have a chat room. Yes, somebody's asked me about a chat room. It's open 24/7. There's no open and close times, but it's mostly active during the US session. And at that, we are at the end of the questions. And what I'd like to do, I would like to say thank you very much all for participating. I will stop the webinar now. I'll send out a recording, and we'll look forward to Cam's webinar next week, where we're going to take these concepts and really move them forward and look at how they help you execute. So thank you very much, guys.